Here's the really good news for you about entrepreneurship and accounting. A lot of the detailed stuff you learned in your basic accounting courses, you don't have to worry about that. What you have to be able to do as an entrepreneur vis-a-vis accounting is interpret the sheets or the major statements and get information off of them. You're not going to be necessarily preparing them. You're just going to need to understand them and then be able to use the information. So this is going to be a bit of a refresher at a very high level of kind of your first or second day in accounting, and we're going to focus on what does it mean to you as an entrepreneur or a small business owner. So you remember the big three in accounting: the income statement, the balance sheet, and the cash flow statement. This is what an income statement looks like. If you remember, it starts at the top with your revenue. You subtract out your cost of goods sold. It gives you gross margin. Then you look at other operating expenses. It gives you operating income, and you keep subtracting out. This is also frequently called a P&L, which is short for profit and loss statement. You're going to find that income statements are really important in entrepreneurship, and it has a lot to do with the fact that it is kind of a profit and loss statement. This is where you can see where the money is really going within the business. And when you look at somebody's financial or at their income statement, you're able to calculate some key ratios. What is their gross profit? How much is going into the various costs and all? And it gives you a really good insight into the business. Also, operating income, or there's a couple of different places you can pull income out depending on what's been subtracted. But in general, income is really key to valuing a business as well. So there's a lot of great information that comes off the income statement. Almost to the point that you would say an income statement is really, as an entrepreneur, what you have to worry about. However, the reason that is not the case is because the income statement does not track cash. And that's a huge but. So the reason that in some cases the income statement doesn't track cash is because there's some things on the income statement that don't necessarily show up immediately in your cash flow. Accounts receivable, for example, someone's bought the product and has quote unquote you billed them, they've received the product, so it's going to be recorded as revenue, but you haven't actually been paid yet because you're granting them terms. Depreciation factors into your income statement, but you don't actually get money back for depreciation. Of the big three, the least valuable to the entrepreneur is the balance sheet. And if you remember, you have assets on one side, liabilities on the other. The difference between the two is your retained earnings. The couple of issues with the balance sheet. As you remember, it is just a snapshot at one time. And that's true for all of these statements, but particularly true for the balance sheet. For established businesses or operating businesses, there is a lot of information that's valuable, especially when you're comparing the ratio of debts to cash flow and those sorts of things. So getting your debt ratio, your current ratio, those are very important numbers that people are going to be interested in. Here are two issues that limit, if you will, the value of a balance sheet, particularly to a startup. The first is things on the balance sheet don't necessarily represent the true market value. And secondly, there are things that you cannot capture on the balance sheet that really matter a lot. And let me give you a couple of examples of that. You may buy a piece of equipment that still really has value to it on the marketplace, but it doesn't have value to you for the business. Where it's on there, where it falls is depending on where you are in the depreciation scheme, and that may not reflect where that equipment is really in its useful life, and that can work good or bad. Second, what's the value of a good location? How do I put something on the balance sheet to say my location is really optimum. How about brand name? How about customer loyalty? These are things that are important assets for a business, but you can't put them on the balance sheet. The third of the big three is the cash flow statement. The cash flow statement can get pretty tedious because it's doing exactly that, tracking the cash flow, and I'm sure from your financial and managerial accounting you have kind of scars on your body from tracking the cash in the various exercises that you did. But because we go back to the opening clip, cash flow is the heartbeat of the venture, it's not at all uncommon in a startup for you to track cash flow on a monthly basis because you just cannot afford to ever run out. And you can see, particularly in a seasonal business, you'd absolutely have to track it and project it out, because it could be that you go, hey, we've got lots of money in the bank, but you realize we're not going to get paid for another 90 days, and we have a lot of expenses between here and that point where we're going to get paid next. And those are the sorts of things where cash flow statements and cash budgets are really going to save your bacon. That is stuff that you probably, I hope all sounds familiar from your accounting stuff. Now let's move this a little bit more squarely into the world of entrepreneurship and talk about when we're forecasting the future. And particularly with a startup, it's a very subjective kind of situation. And this is where we're going to do a couple of exercises working with forecasts. You need three key elements for a good forecast. One is projected sales. The second is how much those sales are going to cost. And the third is your fixed cost. Now these three, sales, cost of sales, and fixed cost, these two are relatively easy to calculate accurately. The really tough one is, what are my sales going to be? And so I refer to forecasts as right-handed data. Now I think due to the camera, I'm not going to be able to illustrate this as I normally do in class. This is by far the crudest illustration I use in class, because normally what I do is I take my right hand, or I say there's only two sources of data when it comes to sales forecasts, and by extension financial forecasts. The first is you take your right hand, you reach it around, put it behind your rear, and you pull it out of your rear. That's source one of data. And source two of data is where you take your left hand, reach around, and pull it out of your rear, which is to say that all of these forecasts are really guesses. The only thing you know with certainty about these forecasts is they're not going to be exactly right. Now that's not an excuse to just go, whoa, I can make anything up. No, the assumptions that underlie those forecasts, which are often spelled out on a separate assumption sheet, this is an important report card, if you will, for the entrepreneur, because when people are reading the business plan and reading the financial projections, they're going to look at those assumptions and they're going to say, has this entrepreneur got any sense about them whatsoever? We'll talk more about the importance of financial projections vis-a-vis the business plan later, but the fact that I tell you very openly these numbers are made up is not an excuse for being woohoo. It is just a challenge to be accurate. The reason that these pro formas are so important is you get some key pieces of information. The first is you get a burn rate. A burn rate is one of those terms of art for entrepreneurship that I want you to know. And it's not very hard. It's how fast are you burning through your cash? Usually it's calculated on a monthly basis. So an investor may say to an entrepreneur, what's your burn rate? And they're expected to hear a number. Oh, we're about $20,000 a month. So that is, if you will, if you go back to our financial model, the fixed costs that are being paid no matter what. Then you have the months to break even, or sometimes it's referred to as the months to cash flow positive. And those are actually two different things, and I'll illustrate those later, but sometimes they get confused. Very importantly, what you get off of the pro formas are a determination of how much money it's going to take. And again, we're going to illustrate this with a couple of class exercises, and then also it allows you to do ratio analysis. that's frankly kind of speculative because now I'm computing ratios based off of made up numbers. That's kind of made up times two. So won't see that so much. But we're going to spend a couple of days doing some pro forma work because I want you to see, first of all, that you can do it. And secondly, why you must be able to do it because it turns out to be really valuable to you. All right, this is what I want you to take away from our discussion through these videos, and it really is foundational. Remember that cash flow model. Cash in, does it come in? When does it go out? And what's my monthly burn rate? Well, and I actually got that backward. When does it go out? When does it come in? And what's my monthly burn rate? And how that model of your business really drives so much of the financial stuff. And you got to know it because you got to get it right. And then this idea of being able to interpret accounting statements so that you have a sense of where the money's going, how much money am I making really, and the ability to project that into the future is going to be really important. I hope you are having, had, about to have, whatever the case may be, depending on when you're watching this video, a great spring break. Our first class back, we'll be doing the Idea Journal presentations on the IJD, and then we're going to jump into some financial exercises. Look forward to seeing you then.